Retailers are zeroing in on the holidays as shoppers gather up last-minute gifts. But how will supply chain disruptions and heightened inventory impact the space as we get into 2023? Bernstein senior analyst Aneesha Sherman and BMO managing director Simeon Siegel are back with us right now. Aneesha, we talked to you at the end of November, and it seemed like you thought we still had a little bit to go in this promotional inventory cycle. Now that we've got a little bit more data under our belts, what's your thinking on when retailers really start to move past this period?
I continue to believe that. And I think the data points that we've seen over the last month have shown that, because inventory levels have not normalized yet. They're still incredibly high. They're coming down sequentially, but they're nowhere near kind of normal levels as percent of sales. Nike, for example, pre-COVID was running at about 15% of sales. They're in the high teens to low 20s right now. I think they will probably end the year in kind of the mid to high teens at best. It will be hard for them to get into that 15% range until next FY. And that's one of the strongest brands out there, right? So if Nike is struggling to clear inventory, then when you think about the tier 2, tier 3 brands out there, it's going to be a heavy inventory first half. I think where that benefits is for some of the clearance retailers, like the off-pricers, because they're able to scoop up that inventory for much cheaper and resell it. And that environment is not going away anytime soon, I think.
Simeon, if inventory levels are starting to improve, costs are starting to come down just a little bit, what do you think what is their biggest challenge next year?
So it's interesting. I think that retail's tough business, right? Brian, you and I have talked about this for years, where they have to focus on forecasting demand, which is hard enough. The last 2 years, they had to forecast supply. That goes away. Forecasting supply is now easily. I mean, you can do that. You know what you're going to get, when you're going to get it, all things considered. So we're back to, how do you run a business? How do you forecast demand? And I think that's this replenishment versus recession conversation that you and I have been having, where at the end of the day, did people overbuy things, or did people, are they not spending now because they can't, or are they not spending now because they don't want to? And that's where I think, to take Aneesha's point, I think that on the one hand, you have the TJXs of the world that will benefit because of excess inventory. On the other hand, you have the Capris of the world, which will benefit in spite of it. There are certain companies out there that are saying, I don't need to promote. I gained brand elevation during the pandemic. I may as well keep it. I spent 15 years losing pricing power since the 2008 recession. I got it back in 2020. I think the brands that can focus on maintaining that pricing power are the brands that are going to walk out healthier in 23.
Who are the brands that are best positioned to outperform, Aneesha, in that environment where forecasting is difficult because you're coming off of some tough comps, and then additionally trying to make sure that you're working through inventory that still is out there and going to be pushed out perhaps to some wholesale partners as well?
Yeah, I think some of the factors that we look at are seasonality of the product. So if you're, in the footwear business, that's a less seasonal product than trending fashion apparel. If you're in, Simeon talked about Capri. If you're in the handbag business, that's a less seasonal product line. Fashion apparel is more seasonal and therefore more subject to issues with not just supply, but also demand. If you can't sell it in the winter, people aren't going to buy it in the spring because you need a fresh line of products in. So seasonality is a big factor. Lead times are a big factor. So if you've got kind of 9 to 12 month lead times, like some of the more traditional brands or department stores do, it's harder to predict demand. If you have lead times that are shorter, Inditex has lead times of kind of 4 to 6 weeks. You're able to turn on a dime much faster as demand changes. So that's another factor. And then value versus premium. And I think value has taken a beating this year as pent-up demand has fueled spending in the first half. But value is going to start to gain some more share and get back the share that they've donated as people are a little bit more cautious now going into 2023 and lapping the strong growth of 22. So those are some of the dimensions that I think will determine the winners.
And of course, Simeon, can't let you go without some form of take on Peloton. It really has been your big time post-COVID call here the past year and a half. Where does that brand shake out next year?
I forgot to show you my latest water bottle, Brian. There you go. Did that for you. Listen, I think that Peloton is probably the most emblematic story that represents everything we were just talking about. They saw their business collapse. They saw their business surge. They built it as if it would last forever, and then it came back down. That is retail in the pandemic. Peloton is just the largest version. And I think when thinking about companies that took these results and assumed they would last forever, the question we have to ask is, did they over inventory or did they over infrastructure? Unfortunately, Peloton did both. So I think right now, I think the new management is doing an excellent job at removing the fixed costs. I think they've been allowing themselves, their default risk has been removed effectively, but that doesn't mean they're a grower. And so I think we're going to go back to this story of what happens with churn now that we're walking through the remainder of the pandemic, now that the average age of a Peloton subscription is no longer a year because you're not doubling up your subscriber base every year. And so I think bottom line, they're cleaning up the business very nicely. They can get to that cash flow break-even level pretty easily because it's under their control, but it does not mean they have this limitless TAM. It doesn't mean they can find more people to buy the bikes as people continue to cancel them. And so for that, I think where we are right now, I'd be more concerned. Still think the product is excellent, but worry that from a stock perspective, it's inflated.
Well, thanks for hanging out with us this morning. Bernstein Senior Analyst Aneesha Sherman and BMO Managing Director Simeon Siegel. Have a great rest of the holiday season. Appreciate it.